Okay, so this is chapter 3, financial statements and ratio analysis. This chapter, I had scheduled 2 classes to cover this chapter because there's a lot of handout work with this chapter. And it's a very important chapter to financial analysis. Actually, chapters 3 and 4 are pretty critical to doing well in the Zoom business financial simulation and understanding how to improve your score and how that simulation connects to this class and why it's a good thing to work on. Okay, so we're going to go over what a stockholders report is, understanding financial ratios and who uses them and why, looking at liquidity and activity ratios, discussing the relationship between debt and financial leverage in ratios, profitability ratios, going to look at how you complete a DuPont system of analysis. And so a stockholders report, how do you produce a stockholders report and why do we produce a stockholders report? Well, one reason is that the SEC requires it for public companies that have make a certain amount of revenue and a certain amount of shareholders. They have to produce a stockholders report. And GAAP, generally accepted accounting principles, they outline the procedures and they follow the authority created through FASB, the Financial Accounting Standards Board. So we have these GAAP and FASB that make up the rules and the formats for a shareholders report, and the main element of the shareholders report is income statement, balance sheet, statement of cash flow, and that's what we're going to talk about tonight. Now, this is always evolving as far as what the SEC and the regulations are on shareholders reports. So we have a big event in early 2002, Sarbanes-Oxley Act. We talked about this a little bit last time. This is meant to correct a lot of fraud that was inside of annual reports. So there are a lot of companies had the accounting got too creative, and they were creating holding companies and special ledgers and special purpose ledgers and just different things that make their financial statements and ratios look better than they were. So when this was discovered and they found a collusion between the audit companies and the companies they're supposed to audit, they made the Sarbanes-Oxley Act to correct for that, to make the shareholder report and the financial statements more accurate, to protect the public's interest and the shareholders' interest in what these companies were doing. All right. So public companies with more than $5 million in assets and more than 500 stockholders are required by the SEC to file a shareholders report. So if you're a private company, you don't have to. And if you're a very small company, you don't have to as well. But if you're 5 million assets, 500 stockholders, you must file a shareholders report with the SEC. So that is the size limit. All right. Now, the American accounting practices and standards are usually tougher than the rest of the world. So, but there are accounting bodies like IFRS, which is International Finance Reporting Standards, and the International Standards Board that can try to make sort of a standardized format for financial statements across the world. In the United States, public companies are required to file using GAAP, generally accepted accounting principles. They can't use the international because it requires more detail than the international. And international companies that want to be listed on the New York Stock Exchange, say like Sony, if they want to be listed on the New York Stock Exchange, they have to prepare a set of GAAP qualifying shareholder financial statements to issue to, if they want to be on an American exchange directly. Okay, so let's talk about ethics. So when you look at an earnings report, you're expecting that the financial and accounting officers who prepared that annual report have conducted themselves ethically in their business and the communication of their progress and financial statistics in the annual report. Now, these annual reports come out annually, but there are quarterly statements. Every quarter, companies generally will report on their performance. If you've been watching the news lately, a number of companies have been reporting their performance. If their performance is better than expected, their stock goes up. If it's worse than expected, their stock goes down. So it's very important to shareholders what these reports say. So if they beat analysts' estimates, their share price usually jumps. And if they fail to beat the analyst estimates, their share price goes down. So managers of companies are tempted to try to manage their earnings because they want to, there's a number that analysts have conjectured saying this company is going to have $1 earnings per share on 15% revenue growth. So if they don't meet those analyst expectations, then their stock price goes down. So a lot of financial and accounting managers are going to want to manage their earnings. So is it unethical for managers to manage their earnings, which basically means they're going to do what they can to make sure they meet their earnings? Well, it's not unethical if what they're doing is accepted by GAAP and FASB, and they can choose to recognize certain items in their accounting books at a certain time. Or they can plan for, if a big expense is going to occur, they may want to plan for that to actually hit or occur the first week of the next quarter. So the last quarter that they're releasing today looks better. So they can kind of move things around, but only where the general accounting principles allow it. So they can't, a big problem is falsifying revenues. And I worked for a Long Island company. One of my first big promotions, I got promoted to a Long Island company, Symbol Technologies, which is no longer around. And I worked at Symbol Technologies for a full 2 weeks before I quit. And the reason I had to quit is because I discovered accounting irregularities in revenue recognition. And I found these big trailers of inventory, and I'm like, what is all this inventory here? Oh, that was sold to a customer. I'm like, but why is this sitting in tractor trailers on our lot? You should mind your own business. I'm like, well, this is my business. I'm working here, and I'm doing the finance and accounting. So then I was like, well, come in my office. And then the guy tries to rough me up a little bit in his office verbally, and I'm just like, go back to my desk, and I'm like, what is happening here? Because at the time, I didn't think it was fraud. I couldn't imagine that it was any type of fraud or falsifying revenues. And then it actually hit me what was happening. So I went to the CFO, and I said, look, this is, I don't know if you realize this, but your guy, your top director dog here is not doing things right, and I think it's fraudulent. So he's like, oh, okay, I'll take this very seriously. You gotta, and then I come in the next day, and then this guy, my boss, is completely insane with me, almost physically threatening to punch me in the face. And I'm just one of those situations you see in the movies, like, yeah, go ahead, you want to hit me? Go ahead, hit me. One of those type of confrontations. And I was like, you know what? I'm done. And I just left. I felt like a real loser because I had like this big promotion. I told everybody they had a party for me at work and a party at home, and it was like, I'm on my way, I'm going to make it to the big time. And here I am 2 weeks later, unemployed. But don't feel bad for me. I found a job the next day at Standard SMC Network. So that worked out for me great because I went to the interview, and I was telling them what I discovered at the interview, and I was telling like all the problems, like, oh, I went there, my desk wasn't ready, and this and that. And so this new company was like, they had my desk and office all ready. They gave me a raise on top of what I made, even though I made that for 2 weeks. So it worked out. But the best part of the story is about a year later, my friend calls me up, and he says, check out News 12, quick. Turn on News 12. So I turn on News 12, and there's my boss being taken out of Symbol Technologies in handcuffs because he was arrested for fraud and unethical, behavior. So they actually do arrest people when they do things like that. So I was just like, quick, set up the TiVo. Or at that time, it was a VCR. Set up the VCR. I got to record this to show everybody. So I was sorry he had to go to jail, but I was just like, yeah, that's what you get for messing with me. Even though I had nothing to do with pointing it out to anybody, I kind of just kept quiet and left, but it's still, justice was served.
What about if you stayed?
If I stayed, I wouldn't deal with that stress. Oh, if I stayed, I'd probably be arrested too. If I stayed and was like, hey, yeah, let's do this. I'm down with, I'm a team player. Let's make fraudulent sales and profits. Okay. I'm good. I'll follow you like all the other sheepdogs that you have working for you. And then I don't know if I would be arrested because I wasn't like the big man on the totem pole, but I certainly, something could have happened. I wouldn't like it. So I'm glad I left. So ethically, even if it means leaving a job, if they're doing something that, you don't necessarily have to be a whistleblower, but there's something that you don't want to be involved with at work. Sometimes you have to make the hard choice, and it was difficult because I needed money and I was embarrassed, and people at my other company I worked for found out, and they were calling me and oh, you couldn't cut it, and rubbing it in. Coworkers are horrible. But so anyway, if you don't want to wind up in jail, be ethical, is the moral of that story. Okay, so the 4 key financial statements. We have the income statement, which is my favorite of all the financial statements. I love the income statement. And these are you have to prepare these quarterly for the purpose of figuring out how much money you made and also for paying taxes. Okay, so here is an income statement that we're going to work on this actually today. I have the handouts. This time I remember to bring them with me so I can land the handout at the same time I'm going over this. But basically, we have this income statement is showing 2 years, 2015, 2014. And the income statement is basically, we start off with a big number up top. And I know this is hard to see. If you do have your textbook, it is table 3.1. Let's see. So I could make it a little bit bigger. Is that better? That's about as big as I can go. Okay, so we start out with sales, and then we have to take away our cost of goods sold. Now, pay attention to this because there's going to be a pop quiz after this. I go over this, so pay attention to how I do this. So we take away our cost of goods sold. So what is cost of goods sold? It's 2 things. For most of you, this is a rhetorical question. I know you know the answer, but I'm going to say it anyway. It's the actual physical material that go into making the product. Maybe it's this thing, the physical materials. Then it's also the labor that it takes to put the stickers on, assemble it. So it's the 2 things: the direct labor, the people who assemble the product, and the materials and components that go into the product. That's the cost of goods sold. Makes sense. Goods sold, it's the cost of the goods sold. All right, so that gives us a gross profit. Just sort of like when you're in the Zoom simulation, you're putting that car together and you're putting down all the features in there. That's building your cost of goods sold on that line in the simulation. So you get to see how much profit you're making your car is generating. Then we have our expenses. So are expenses good? Do you like expenses? No. Who said yes? You should not like expenses. Expenses are bad. You have your telephone expense, your cable expense, your Netflix expense, your Hulu expense. You have your tuition expense, your auto insurance expense, your gasoline expense, your tax expense, your credit card expenses. Too many expenses, too many monthly bills, but it's the nature of life. So you just have to know that we don't like them because they take away from our profit. So we have this gross profit, selling expense. What do you think that is? That is what money that we spend to help sell things. Maybe it's through advertising, maybe it's through personal salespeople. So we have our selling expenses. We have our general administration expenses. This should be very important to you. You know what this is? This is what you're going to be in the future. You're going to be in this general and administrative expenses. So if you're going to work in accounting or finance or sales and marketing or operations or management, you're not, unless you're aiming for a career where you're going to assemble a product, you're going to wind up in S&A expense. And these are the professional people that kind of run the company. So your salaries are an expense. Lease expense, if you're leasing a building or a car. Anybody have a car lease or rent an apartment? Yeah, those you like those expenses when they come up monthly? No. And then your depreciation expense. This one I talk more about next chapter. We go a lot more into depreciation expense because it's not something you deal with in your real life too much. But it's an expense. You just need to know if it says expense, you're subtracting it from your profits. So after we subtract all these expenses, our total operating expense is $568. So in the simulation, you have your gross profits and your operational profits. Now, the one thing you can control in your operational profits is advertising. So if you advertise too heavily, you may see your operational profits decline too greatly. So you need to keep an eye on that. In the simulation, when you do advertising, you should take the total amount of money you're advertising per vehicle, maybe it's $10 million, and divide it by the amount of vehicles you're actually going to sell. So that way you figure out how much advertising you spend per vehicle. So if you have $4,000 of gross profit on that vehicle, and you're advertising $5,000 worth of advertisements on it, you now have a $1,000 loss. So you need to keep that in mind, that what you're advertising in relationship to per car level. Okay. Now once we have our operating profits, we have to take away our interests. Operating profits are also known as EBIT, earnings before interest and tax. So take away our interest expense. So we have our net profits before taxes. Take away our taxes. And then we have our net profits after tax. And then we have this thing called preferred stock dividends. So we have to pay these preferred stock dividends out of our income. And then we have earnings available to common stockholders. And if we take this number and divide it by the amount of outstanding shares, which would give us a number down here, divide this by the amount of outstanding shares, we get our earnings per share. And then here, this is down here is telling us what our dividends per share is. And then out of our earnings, we can pay dividends. So when we have earnings, this is really critical that you understand this. There's only two things you can do with earnings. You can pay a dividend or retain the earnings. If you retain the earnings, you're keeping them in the company to reinvest. If you pay dividends, you're giving them to shareholders. Okay. Yes.
Would there be a benefit of paying a dividend instead of reinvesting?
Yeah, shareholders will like you more. Pay a dividend, shareholders will like you.
So wouldn't you rather reinvest?
That's for your financial manager to decide. So your financial manager looks at, should I take this money and reinvest it, or should I give it to my shareholders? So if there's a better investment they can make that could return more to my shareholders in the future, you make that investment. However, if you say you're a utility and you can't expand because of you only have a certain territory and you're making hand over fist money, but there's really nothing you can do with it legally because of regulations from the government, then you could return that to investors because you can't invest it. So that's what you have to decide as there's also a third thing you can do is you can buy back stock. So you can take these profits and buy back stock rather than, and that itself boosts the stock price and improves all the financial ratios. So in a way, that's also pleasing investors. So financial manager is the one that has to figure out what's the best thing to do. Okay. So what I'm going to do is I'm going to pass out. Okay. So what we're doing here initially is we're just bringing down the information. So, but profit, gross profit, has to be calculated. And like I showed you on the handout, we take the sales minus the cost of goods sold. Let me get the correct formula in there. Okay. Selling and administration expenses is up here. Depreciation expense. So operating profits are going to be our gross profits minus selling minus depreciation. Interest expense. Earnings before tax. We're going to take our operating income minus our interest expense. Our taxes are $100,000. Earnings after tax. Take our earnings before tax. Subtract. Okay, are you with me so far? So here, 600 subtract 200 is 400,000 gross profit. 400,000 subtract 40 and 20 is 340 operating profits. Here we're subtracting the expenses. So gross profit subtract selling, subtract depreciation, we get our operating profits. Then we take our interest expense, we subtract it from our operating profits to get our earnings before taxes. We put our taxes in, we subtract our taxes from our earnings before taxes, we get our earnings after taxes. See how this makes sense? And remember, it's like your paycheck. We just keep chipping away at that at your top number. So you have your gross pay, and then you have your net pay. I think your net pay should really be called your gross pay because it's gross the amount of money they take away from you. But if you think about it, you start out with a pretty nice sum of money, and then FICA, Medicaid, state tax, federal tax, health insurance, 401k. After all that's said and done, you'll have to see 50 cents on the dollar that you make. So if you make $10 an hour, you're really making $5. If you make $100,000 a year, you're really only taking home $50,000. So now the bottom gets a little difficult here. Difficult, let's see, preferred dividends. Where are the preferred dividends? Here we go. 80,000 in preferred dividends. So now when we calculate earnings available to common shareholders, we have to take our earnings and subtract the preferred dividends. And that's how we get earnings available to common shareholders. Outstanding shares. Here it's the only one that's not a dollar amount. It's a number of shares, outstanding, stock. So to get our earnings per share, we take our earnings available to common shareholders, and we divide rather, our outstanding shares, shares outstanding. And this gives us our income statement. So now that I went over it, if you got this wrong, or maybe you couldn't finish it, didn't know how to do earnings per share, you can start over on the second problem to reinforce it and try the second problem. Okay, so there is this other element to this handout called the common size. So in the homework, in the spreadsheet work, possibly on the test, it's going to ask you to prepare a common-sized income statement. So what we're doing here is we want to make percentages. So to make a common-sized income statement, what we're going to do is we're just going to take revenue. We're going to take everything and we're going to divide it by revenue. Now, revenue divided by revenue is going to be 100%. Revenue is another term for sales. One thing we do in finance to make sure that we remain high paid is we come up with different terminology for the same thing so we can confuse people. So it's sort of like taxes, like, oh, I can't possibly do this, I need to pay someone to do it. So we try to make finance like that. We make it really mystifying so that way people always want to hire us to do it for them. And one way we do that is all these different confusing terms. But sales are revenues. So I like to interject some of those different terms so that way if you ever come across revenues at work, you don't look like a complete jerk by saying, what is revenues? So as my textbook talked about with sales. All right. So now, what I'm going to do here is in the formula, I'm going to actually put some absolutes. These dollar signs, I'm going to put that on cell C14. Because I want to lock down this cell. And once I lock down this cell, I can just copy this formula down. So I'm not going to actually... Okay. So how did I want you to calculate these two right here for 2015. This is 2015. Cost of goods sold and gross profit. Calculate by hand the percentage of sales. And again, what we're doing is we're going to take for cost of goods sold, what we would do is we would take cost of goods sold for 2015 and divide by sales for 2015. That's how you get a common size. You are not going to understand this unless you actually do it by hand. All right, so just try the gross profit. What percentage is gross profit? Yes, in the back. Yeah, you can do that in Excel. But I don't want you to do that right now. I want you to actually try and calculate one. Okay, so why we do this common size income statement is we're trying to compare what's happened in 2006 compared to 2015. So here, because sometimes when we look at numbers by themselves, it doesn't tell the full story. We know a number went up, but we don't know really by how much. So a lot of what we do in finance is work on percentages. So here, our cost of goods sold went down from 38 cents to 33 cents. So that means that instead of paying 38 cents in cost for every dollar of sales, now we're only paying 33 cents. And that directly is how I get this gross profit. We calculated this by taking gross profit divided by sales. I could have also took the 100% and minus the 38.2%. Because together, cost of goods sold and gross profit together are sales. So there are two ways of calculating this one. But here, it's improving if the costs go down, I'll tell you right away the gross profits improved. That's all I need to know. That cost of goods sold went down, percentages, and I can tell you that without calculating it, gross profit improved. And these are what's written about and talked about in the earnings release. We improved our gross profits from 61 to 66%. You don't say, I improved my gross profits from 520,000 to, you don't put the numbers, you do the percentages when you talk about it. Okay, selling and administration expenses. Did we make an improvement here? Yes, this is an improvement. So we must have laid some people off. Or we increased sales enough that, think of these selling and administration expenses as fixed costs. Your salary is your salary. So if I can sell more, the fixed cost as a percentage to sales goes down. So I could have maybe even hired some people, but still the percentage is going down because our revenues went up. So that's a good thing. Now, depreciation expense went up. That's really not something you need to look at because it's a non-cash charge. We'll explain that in the next chapter. Operating profits went 51 to 56%. So that's an improvement. Interest expense went down, so that's an improvement. Earnings before tax went up. That's an improvement. Taxes went up. That's not an improvement. So the percentage of taxes went up. So so I would, as a financial manager, say, okay, why did our percentage of tax go up? And then the tax accountant would come and say, well, we're in a new tax bracket now. So all this additional profit we made is being taxed at 39%, not 34%. Remember last week when we did that? So that would be what a financial manager would say is, why? Why do our taxes go up? Why does this percentage go up? I have to explain this to investors. I'm upset about it. And then you have to say, okay, well, this is why. We can't help it. It's the government. All right? Okay. Earnings after taxes actually still went up, but it's only about 0.9% because of the tax situation. So this company should really hire a better tax accountant to figure out how to lower these taxes. Preferred stock dividends increased. Which, actually, they shouldn't really increase. But they did. Okay. That's because I did this by hand. I mean, it's not a real world example at that point. Okay. Earnings available to investors decreased because of the preferred stock. Okay, I can explain this. Maybe we issued more preferred stock, and that's why our dividends are higher. We issued additional preferred stock. So our earnings to common shareholders are down. So now, even though you have a great top of your financial statements really good, and investors would like that until they get to this point. And this is what's going to kill your stock. Investors are going to say, you know what? I'm glad you did better as a company, but I'm getting less percentage of sales as my share as an individual investor. I'm selling the stock because you're not really looking out for my best interests. Outstanding shares increased. This is another reason. If the outstanding shares increase, that means the amount of money that you're going to get is going to be divided over a bigger base. So here the outstanding shares are 125,000. In the previous year, this is 2015. So it actually in 2016, it's 2016? 2016 it actually goes down. So that's a good thing. So actually, outstanding shares, do I have this reversed? I think I have this reversed. Let's see. Maybe not C. No, that's right. C. No, this is not reversed. 2016, 2015. Okay. It's because the revenues have increased. No, the revenues. What's happening here? Percentage. If I make this 100%.
There were more sales on 2015.
Yeah. Just trying to figure out a way I can explain it. The 2016 outstanding shares were 16% compared to the revenues, and in 2000. Yeah, you know what? You know what it is? This is something that you don't look at. That's why I'm confused. This doesn't matter. What matters, though, is the earnings per share. That's why I was getting confused. You don't do a outstanding shares outstanding percentile, because that's meaningless. What you do is the earnings per share is what's important. So let me go and open this up a little bit. Ever get this number sign hashtags here? What do you do when that happens? It means you go to Twitter. Hashtag. You just open them. I just double click the column to open them up. So we have earnings per share is here 0.202% in 2015, and here it's 2.127%. So we're having in 2016 we're having a higher percentage of earnings per share than in 2015, and that's a good thing. And you would expect that because you have $1.72 per share here, and you have $1.30 here. So you'd expect this number to increase. If I just said that earnings per share are $5, then, oh no, we don't. I want to. If I said earnings per share in 2016 were $5, you see that it's even larger percentage. Okay. All right. I'm going to move on back to the lecture. Now, as a personal finance example, this would be, remember I was equating the income statement to your paycheck? So here, we had salaries of $72,000. That's this is your annual income and expense statement, which is an income statement for an individual. So you have your salary, any interest and dividends, so your total income is $73,000. Not a bad income, but remember that's income for two people here, Jan and John. So the mortgage is $16,000 a year as a mortgage. They must have a pretty big house. It's a nice size. Unless they live in Long Island, then it's a small house. Now, auto loan payments, utilities, home repair, food, car expense, health care and insurance, clothes, shoes, and accessories, insurance, taxes, appliance and furniture payments, recreational entertainment, tuition, books for Jan. Damn that Jan going to school all the time. Personal care items. And so our total expenses are $61,000. So our cash surplus or deficit, that might seem familiar to you from the practice rounds, is $11,000. That's what they're able to save. Oops. Now, this is important because when you start dating, you're going to want, on the first date, to ask for an income statement from the person you're dating. It's very important to say, and I do this on all my first dates, and that's the reason I don't really have many second dates, but on the first date, I'm just like, can I see your income statement? And they usually say, what are you talking about? I don't have an income statement. I'm like, well, these are the things I'll need from you, and I'll construct it for you right here at the table while we're waiting for the appetizer. You know, but it's important to know, like, how much you make, what your expenses are, so I know what I'm getting myself into. Plenty of people have gotten married, and then they find out once they're married, oh, honey, guess what? I got $40,000 of students' loans and $60,000 of credit card debt. Isn't that funny? Yes. To a person, you have the spender. So you have the one person that's good with the finances and the savings, and you have the one person that likes to spend everything. So you have parents, you know, one of your parents is the financial person, knows what they're doing, and the other parents is like, let's go on vacation. You know, let's buy another house. So now, if you have a relationship where two people are the financial people, that won't last because they'll fight a lot over money, and they'll never spend anything. And if you have two people who are spenders, that won't last because they'll spend all the money and then fight about not having any money and, you know, going broke. So that's why you always want to seek out. So as a financial person, I'm always seeking out someone who's a financial mess. So, you know, I can control their financial situation, improve it, and it's sort of like how it works, you know. Have you seen that movie, 50 Shades of Grey?
No.
Okay. I still have the same situation there.
I gave them the argument of
All right. Okay, balance sheet. Sorry for having it in this format, but it's easier for me to control what I'm doing with the overlay. So, balance sheet is the next critical financial statement. And what the balance sheet does is gives us a financial summary of our position today. What is our financial position today when it comes to assets, liabilities, and equity? How much are we financing to pay for our assets? How much of the equity is money we provided? So equity is good. This is the money that we are putting into our lives or our business. Now, financing is money we borrow. And that's not as good because we have to pay it back. And there's a cost to borrowing that money. So if you look at your financial education, how much of your financial education is borrowing student loans, and how much of it is money that you're putting in, either you or your parents are putting into it? So say you have $100,000 of college-related expenses. That's your college is going to cost you $100,000. You know, you're taking $60,000 out in loans and $40,000 that your parents save for you. And so that would be your equity to debt to equity split, 60-40, or 40-60, depending on how you're looking at it. Now, if you're paying $100,000, you're being charged too much at this school, I'm sure. It's not that much, 4 years here. But I'm not actually sure what the tuition costs. But I know it's a lot more than I paid. So, let's move on. Okay, so we're going to look at this. So this is something I can't do this when it's the spreadsheet presentation. I can't make it bigger like that. But here I can. So let's look at this balance sheet. We have 2 years, 2014 to 2015. And we start out a balance sheet. We start out with assets, and the most liquid and current comes first. So cash comes first. Marketable securities, which is like a money market account or a savings account. Anybody here have a savings account? Okay, good. 2 people. Accounts receivable, which is money we lent to somebody that they're going to pay us. We can count that as an asset. So say you lent some money to your brother or sister, and hopefully at some point they're going to pay you back. You can put that in the asset section of your balance sheet. Money you lent to somebody, and they promise to pay you back. That's an asset. And inventory. These are all current assets. So we add up our total current assets. So you see this little line here? When you see a line, that means you have to do a calculation. And this line here should actually be a double line. Well, it's actually a line saying the calculation is complete. So we add up these 4 items, we get 1,200. And then we have our land and building. So if you own any land or buildings, that's an asset, but it's a long-term asset, or what we call a fixed asset. You have machinery and equipment, furniture and fixtures, vehicles, other, including financial leases, can be considered a asset. So the total fixed assets at cost would be $4,660, and then we have to subtract from that depreciation. So ever have a car that's brand new and nice, and then 6 years later it's old and busted? Is it worth the same price you paid for it? No, it depreciated. All those coffees you were drinking in your car, all those muffins you were eating, all those
Fried chicken.
yeah, fried chicken in your car, getting that grease everywhere, staining the seats. Depreciation.
Like chicken.
Yes. Now, you take away your accumulated depreciation, and you got your net fixed assets. Add your net fixed assets to your total current assets, and that's your total assets. So fixed and current, yes. Yeah. This is a KISS balance sheet. Do you know what that is? Keeping it simple, student. So we're not going to depreciate each individual asset because people's heads would explode. Like, you see that commercial where they're looking at the sales deal and then their head explodes and purple dust comes out? It's like one of those new sales websites. What's the name of that website? Jet. But thank you whoever knew that was Jet. I couldn't remember what that was. Okay. However, if you are taking the accounting concentration, hopefully they'll bring that up there. That's where it's like, you're doing an accounting concentration? Okay. This is just sort of a review to get you back on paces with this stuff. But I like your eye for detail. It's going to serve you well. All right, so this is more commonly what a full balance sheet looks like. But before I go to that, let me do the liabilities and equity section. So here, we start with our current liabilities. Accounts payable. This is money we owe other people. It's the opposite of accounts receivable. Notes payable are like bank loans. And accruals. Accruals, money that you owe but haven't paid yet. So again, this is money that a liability that you owe, like salaries can accrue. It just means that there's something that you owe that's accumulated but you haven't paid yet, like taxes. You're accruing your taxes but you haven't paid it yet. So that's considered a liability. So our total current liabilities is $620. Long-term debt is like bonds, 30-year debt. So total liability is $1.6 thousand, or in the millions actually. Okay, preferred stock. If we look at a preferred stock, we're going to look at our dividend at par, put in a preferred stock because it's a liability. We have to pay those dividends. Our common stock, here we're looking at a dividend as well for our common stock at par. And then our paid in excess of par on capital stock. Okay, let me explain common stock par. Actually, it's not a dividend now that I'm remembering. Par value is the stated accounting value of the stock. So if money is paid in excess of that par value of the common stock, it's listed here. These again are accounting terms. So this isn't the actual price of the stock, it's the par value price set in the accounting books for the stock, which is always different than the actual real stock price. So if any capital was paid into the company outside of this par value of the stock, it's listed under paid in capital excess of common stock. And then we have a retained earnings. This is any profits the company makes and we keep. So total that together, and that's going to be our shareholders' equity. We add our liabilities and equity together, and we get our total liabilities and shareholders' equity. Okay. Now, this is what a balance sheet typically looks like. And again, this is a more personal view, but typically a balance sheet is laid out with assets on the left, liabilities and equity on the right. And they must balance. Total assets and total liabilities and equity has to balance. Sometimes equity is also known as net worth. So this is a common layout. This is their attempt at being like a personal finance. If you look at like something you would see in more of a person on a company would have. But this is typically the balance sheet layout. And again, the idea here is that if you have assets, this is the main idea. You have assets, they didn't just appear out of nowhere. Your assets were paid for. And the only way you pay for those assets is either money that the company has through retained earnings or equity that shareholders brought to the company, like when you sell stock, or through borrowed money. So if you buy a new car, part of that new car would be money that you put into it when you put money down on the car. That's your equity. And the rest you're borrowing in the car loan. So you can't get that car unless you have a source of funds. It just doesn't appear out of nowhere. And it's either equity or liabilities are your sources of funds. Borrowed money or retained monies from working operations. And that's all the balance sheet is saying. So the balance sheet has to balance because none of these assets here can appear without the equity and liabilities to pay for them. And that's how they always balance. So it's really just separating. You want to look at your total assets and say, and this is another thing you do. Second thing you ask for in a date is a balance sheet. So you want to know, say, okay, I'm going to talk to the ladies for a minute. This guy pulls up in like a really cherry car and has like a Tag Heuer watch, nice clothes from like, what's the expensive clothing store? I don't even know, obviously.
Kmart.
Okay. Nordstrom, Bloomingdale's, Vince, Bone and Rag. These are the shops I don't go into at the outlet center. I'm just saying the ones I know to stay away from because they're $171 for a shirt. Banana Republic is not bad. It's actually reasonable. I shop there. You get, factory outlet. All right. So you see this nice car, right? So after the date, of course, right? What do you do after your first date? You go home with the guy, right? And you go to their, not to have sex with him. Ew. No girl wants to have sex on the first date. You go into the house to see what the house looks like. Where do you live? I can't decide, right, ladies? You don't want to go on a second date on someone that lives with their mom. So you want to take that car ride to see, wow, you have your own house and this great car, and you spent and bought dinner at an expensive restaurant? This is a guy worth dating, right? But wait a minute. That's where I come in. I pop in the middle of the date, and I said, listen, he may have all these great assets. He has this house and this car and his fancy clothes and his $2,000 watch. But you know what? He paid for all this on loans. He used his student loans to pay for everything. So he doesn't have an education because somehow he's able to take his student loans and buy a house and all this fancy stuff and the 80-inch screen TV, and he owes all this debt. So if you get involved with this guy, he's going to run out of money pretty quick, because the next statement we're going to look at some point is the cash flow. And you're going to see that once he spends all the borrowed money, they're not going to lend him any more money because he's maxed out his credit cards, he's maxed out his student loans. So now they're going to take that car back when he can't make any more payments. They're going to take that house back when he can't pay the mortgage. So that's why it's really important. Someone may look really flashy and great on the surface, but then you find out it's all paid for through liabilities. That's not the person you want. What you want is the person driving the Honda Accord that pulls up to a 3-bedroom ranch in a so-so neighborhood. And when I say so-so neighborhood, that means I'm probably living there. And that's what's made it so-so. But this guy has a car he's already fully paid off, and a house he's paid off, and he has no credit card debt. You just found the financial match to your financial mess. And that's where the second date comes in, right? So I've solved all your dating problems. It works the other way for guys, too, if you want to flip it around. Because as a guy, you want to look for a girl that has her financial act together as well, especially if you're a financial mess. And hopefully, she won't ask you for your balance sheet. All right. Statement of retained earnings. This reconciles our net income during the year and any cash dividends paid or any retained earnings. And like I was saying, this is a very important concept. Any money that's made, there's two choices. You either pay it out as dividends to your shareholders, or you save it internally in the company to reinvest. So like we went over this example before. If the company has better options, say you're a company like an up-and-coming restaurant chain. You want to retain those earnings so you can open up more and more branches or locations. But if say you're McDonald's and you have every location that you could possibly open already, maybe you return some of that money as dividends because you really can't, you're making so much money you can't spend it fast enough. So that's something we like to look at. All right. So here's a typical statement of financial retained earnings. We have a retained earnings balance. Now, that's the thing about retained earnings is they're always accumulating. So we start with a balance from last year, and then we add any net profits. Net profits after tax, and then we take away our preferred and common stock dividends, and that's the remainder is our retained earnings. So this is a number that, as long as you're not paying everything out in dividends, should grow every year, as long as you're making a profit. If you have a loss, then that's not going to grow your retained earnings. Okay, so the fourth statement, we're going to actually pause here. Now this is a really important, and remember, this is just a review for finance. This is not really meant to show you how to construct all of these financial statements from scratch. This is something you should have experienced before in one of your other classes, and this is really just a review, so when we go into the financial ratios, you have a basis of where they're coming from. So the book is designed to review financial statements, not necessarily show you step-by-step how to calculate them or create them. You really should have had that knowledge before you came to this class. But luckily, you can go to one of, I just checked on Google, one of 21,767 sites that will show you how to construct an income statement or balance sheet. Also, if you want, you can go to YouTube and just type in see how many YouTube videos. You know, how to make a balance sheet. And it's the wonderful internet we have here. And it'll come back with plenty of resources. Also, lynda.com is very good for that too. More professional than YouTube. So here you go. You can actually watch this professor do it if you want to have a refresher of how to create a balance sheet. So, but we don't have time for this slow download to actually link that up. Okay. So statement of cash flows, what we're summarizing here is where the money's coming from. Where is the cash coming from? And there's really only three sources. You have your business operations, your investments, and your financing. So operations, investments, and financing. So operation, that's the best source of cash flow. That means that your company is working, it's making money, and you're getting cash from your company. So you have a business, think of a small business like a laundromat. People are coming, spending money to do laundry, and that money's creating a profit from you, and that's going to be cash flow from operations. Okay. Although the net profit is very rarely equal to the actual cash the operation throws off because of certain non-cash charges that makes the net profit look smaller than the actual cash the business generates. So that's why when you ever analyze a business, you always analyze the cash flow, not the net profits. If you're looking for mergers and acquisition or to buy a business, you want to see cash flow. Now the second thing is investments. So if the company has some investments and they wind up selling those investments, they can make additional cash flow from that. At one point, McDonald's had a significant investment in Chipotle Mexican Grill, and they sold that and made a significant profit off of their investment in that other restaurant establishment. And that would go under the investment section of the cash flow. Just like you, if you made an investment, you bought a stock, the stock price went up, and you sold it, capital gains, that would be your cash flow from investments. Financing would be cash flow from borrowing money. That counts as cash flow. So if they go, just like the early example, if someone goes out and maxes out the cash withdrawal on their credit cards, they can look like a big spender at the casino or the restaurant, seem like they have a lot of money because they're increasing their cash flow from borrowing. Or they can take out a bank loan or a personal loan or a student loan. But this statement is important because it provides an insight into what the company is doing and how the operating activities are contributing to the cash, and how it ties together to the income statement and the balance sheet. Because you can't generate a cash flow statement without both the income statement and the balance sheet to get your information from. All right. So here's a cash flow statement. So we have our cash flow from operations. So our net profit after taxes is where we start. So this company made profits. And we add back our depreciation on the cash flow statement because depreciation was taken out of our income statement because it's an expense, but it's a non-cash expense, meaning that there's no real cash disappearing for it. You're not spending any cash to make that for that expense. Because how this works is with depreciation, you buy the asset first, and that's when the cash is deducted from your balance sheet. As the asset depreciates, you're allowed to claim depreciation expense to reduce the value of the asset. But you don't pay anybody that depreciation expense, it just happens. So that cash is not really disappearing like it looks like on the income statement, so we add it back to the cash flow statement. And depreciation, again, is something that we talked about in the next chapter a little bit more. Increase in accounts receivable. So if accounts receivable increases, that means you lent more money to people, okay? So say you're sitting in the dorm and you have 3 suite mates and they all want to borrow money from you. And that's basically increasing your accounts receivable. Does that mean your cash is increasing or decreasing? Just think of it. You lend money to people. What happens to the cash in your pocket? It decreases. So if accounts receivable increase, it means you lent more money to people, your cash is decreasing. A decrease in inventories. If your inventories decrease, that's going to be an increase to cash. Because how does your inventory decrease? You sell it. So any decrease in inventories we count as an increase in cash flow. Increase in accounts payable. This is an increase to cash flow. So if you have a credit card and you start your day with $100 in your pocket, and you go to get gas, you put in a credit card. You go to the mall to buy a shirt, you put in a credit card. You go to the movies, you put in a credit card. You go to dinner, you put in a credit card. Has your cash flow decreased? No. But, so we're going to count any money you put in that credit card, we're going to count as a cash flow increase. So if you increase the amount that you owe somebody, it's like borrowing money from your brother, or your sister, your parents. You're borrowing this money, that's an account payable. You have to pay back at some point. But this is like cash going in your pocket. So if you hit your mom up for $50, and your dad up for $50, and your older brother up for $50, they're all three of them, you've increased your accounts payable by $150. But that's $150 of cash you can put in your pocket. Increase in accruals is similar to accounts payable. Accruals, again, is money that you owe but haven't paid yet. So cash provided by operating activities, these will all be considered operating activities. So now, if the opposite happens to any of these, if we have an increase in inventory, that's a decrease to cash. If we have a decrease to accounts payable, that's going to be a decrease to cash. So they work both ways. This has to be stated one way, but these accounts can go either way. Okay. And that's usually a really hard thing for students to understand, how receivables, inventories, payables, accruals, and depreciation affect cash flow. And this is really tied to your fundamental understanding of accounting. So if you understand what accounts receivable is, don't feel bad. I graduated college, and my first job was working in accounts receivable, and I was just like, what's accounts receivable? And like, don't you have a degree in accounting? I'm like, don't you have a big mouth and should shut up? You know? And that didn't go, you shouldn't tell that to your boss, though. They don't like that. But anyway, I figured out what accounts receivable was later that day. And that was before Google, so I was even, I had to look up an encyclopedia. No, I'm just kidding. I knew what accounts receivable was. I can't believe you fell for that story. But if you are an accounting concentration person and you don't know what accounts receivable is, good luck getting a job and keeping it. Okay. Cash flow from investment activities. Increase in gross fixed assets. Okay, so if you increase your fixed assets, that means you paid money to buy more assets. That's going to be a decrease to cash. Change in equity of investments. There's no change here. So cash provided by investment activity. So we look at fixed assets as an investment. So we're investing in our business. Just like in the Zoom simulation, you can invest in operational investments. There's that section in production. It says operational investments, and you spend money. That is going to decrease your cash. But it's an investment in the company. It will make your company more profitable. And I've seen in a lot of your practice games, you weren't investing in operational investments, even though I made it clear in the instructional video that you should do that. And that's why you're winding up with so little points in the practice rounds. So, but that's okay. That's what the practice rounds are for, is to learn these things. So when you do the team competition, you'll be able to kick all the other team's asses by learning your mistakes in the practice game. So that, just think of it. When your team gets together, and all 4 of you, or 3 of you, or 2 of you have completed, 24 rounds of practice, you're going to be pretty, have a lot to contribute to the team decisions. Moving on. Cash flow from financing activity. So if you're having a decrease in any type of financing, that means you paid it off. If your credit card bill decreases, you paid it off. So that's going to be a decrease to your cash. But if you increase your debts, that's going to be increase to cash. It means you borrowed more money. Increasing your debts is borrowing more money. Change in stockholders' equity. Issuing new stock could change stockholders' equity. Paying a dividend. If you pay a dividend, it's going to decrease your cash. Pretty obvious. So cash provided by financing activities. So if I add the 3 of these together, the 500 from operations minus the 347 from investment activities minus the $61 from financing activities, we get a net cash increase of $92. But that $92, I'm not so concerned about that $92. I'm more concerned about where's the money. Like this cash flow statement, I think I like because you're making cash from operations, which is critical. I wouldn't want to buy any business that can't make cash from operations. You're investing in the company, so even though it's reducing your cash, that's an investment in the company. That's a good thing. And here you're paying out. You're reducing some payables, although you took some more long-term debts. You're paying a dividend. Those aren't necessarily bad things. So I would say all in all together, this isn't that bad of a cash flow statement. And this is what the analysts will do. They'll look at these cash flow statements and say, hey, your business is only running, it's only afloat because you borrowed a lot of money to keep it going. You have losses, your operations aren't contributing anything to your cash flow. It's all from borrowed money. That would be a poor cash flow statement. And that's why we analyze these cash flow statements to look at that. Now, when you read the textbook, they'll explain this a little bit more depth, particularly how these different accounts affect the cash flow statement. Luckily for you, I'm not asking you to make a cash flow statement. Although in the spreadsheet, I will ask you to do an income statement and a balance sheet, but I'm not going to ask you to construct a cash flow statement because it can get a little tricky if you're not well versed in your accounting. Okay, so consolidated international financial statements. Companies are international, so you have financial statements in many different countries, or you're operating your finance and your business in many different countries. So if you look at a big international company, like say Starbucks, there's Starbucks all over the world. Now, when they're making let me give you a better example. There are some companies that have their domestic operations and foreign operations. So even Apple has their domestic headquarters in California, and they have sort of like a headquarters in Ireland. So when they have to make a consolidated financial statement, they have to take the assets from all the businesses around the world and make it into one financial statement. So they have to translate the foreign currencies from all these foreign subsidiaries into dollars to make it consolidated, because they can't show, they can't have a balance statement or income statement with multiple currencies on it. It has to be all one currency. So it's basically sort of think about taking these financial statements from all these different foreign subsidiaries, converting them to dollars, and adding them together to be one big financial statement, all accumulated. So you have to look at the currency rate translation method. How are you translating the dollars into dollars? Are you consolidating them at year end using the current exchange rate? That's typically what most businesses do. So you want to, even though the rate's changing all year long, you wait, especially the balance sheet. At that point in time that you construct the balance sheet, you use the exchange rates for that day. You're constructing the balance sheet, so you have an actual accurate view of how much money the company's worth in dollars. Income statement, using revenue expense, they could be treated in a similar fashion as well. But FASB 52 is the FASB paper that talks about how to do that effectively for a business. So businesses, before they're international, have to figure out how they consolidate their financial statements. Now, for equity accounts, you want to use a translation of the exchange rate at the time of the transaction. So whenever the investment was made, use the exchange rate in the day the investment was made. So if you're investing in a foreign building or a foreign factory, you want to calculate the cost of that as the actual cost that day with the currency translations on that day, not revaluing it at the end of the year. So it's sort of locked into that one period when you actually purchase. So equity accounts are a little bit different. And retained earnings, those actually you can value at the end of the year, but you're adding up together all the profits and losses from the different divisions into one financial statement. So you may have 3 divisions that made a huge profit and 2 divisions that have a loss, but overall the company's showing a profit. So you have a company like Google, which is now called Alphabet, and they call it Alphabet because they have all these different divisions. So when Alphabet produces consolidated financial statement, they sometimes will break out, sometimes they don't break out, and sometimes they can if they want to, how the other portions of their company is doing. So sometimes what a company will do is they don't necessarily want shareholders want to know how individual segments are doing, so they can consolidate it and not reveal that if they want to. Yes?
I think I was looking at the stock market, like maybe and Alphabet had.
Okay. All right, so we finally made it to ratio analysis. So ratio analysis is what the financial people use. So basically, the accounting people put together the financial statements. Now, if you're a financial analyst and you have to look at, say you're analyzing an industry of 20 companies, you can't go and look at 20 companies' income statements, balance sheets, and cash flow statements. They're just not comparable. They're all different sizes. They have different nomenclatures and different structures. It's just, there's no way of analyzing companies easily looking at all these financial statements. And when you look at like a professional business financial statement, balance sheet, income statement, they're pages and pages and pages. They're really big. You know, I mean, you should really do this as an exercise if you're curious. Find an annual report of a big company and then look at their actual financial statements. They're a lot more involved than what we're going over here in class today because there's a lot more, they have a lot more stuff going on as a big company. Now, ratio analysis is a quick way to cut through all that red tape and see what's happening and analyze these companies a lot faster. So it's sort of a shortcut to analysis to find out how these companies are doing. So it involves calculating and interpreting ratios to analyze and monitor for a firm's performance. And you can monitor it in a couple different ways. You could just look at a firm's performance in a year-over-year setup, or a firm's performance, them against the corporations. Okay, so here's a demo that I ran of the Zoom simulation, and we see that we have our financial ratios here, many of them the same that we're going to have in the textbook. And I have year 0 and then year 1. And this Y over Y field over here is looking at, this stands for year over year. So if my revenues per share were $12 in year 0 and I increased them to $21 in year 1, that's a 75% increase year over year. And of course, I'm going to earn 75 points for that. So you see how this overviews are calculated? This is looking at your financial ratios in a year over year comparison. Just like your report card. You want to see that if I was your parent and you were in high school, I guess, because you don't do this in college, but you want to see, are you going from a B- average to a B+ average? Then year over year, semester over semester, you're improving. Just like when you look at your own transcripts here, you want to see that, say you want to apply to a graduate school and somebody was reviewing your transcripts for the graduate school, and let's say that you have a 3.0 average and you have a 3.0 average. Now, your 3.0 average, you're going from A's as a freshman to B- as a senior, and you're going as B- from a freshman to A's as a senior. You both have the same grade point average, but you're going downhill and you're going uphill, so I'm going to accept you and reject you, even though you have the same grade point average. Because it's not the grade point average, it's the direction of where your grades are going. You know, and you say like, well, freshman year I had no friends, so I really spent a lot of time with my textbooks and studied, but then I joined a few clubs and I got busy, and I didn't really pay attention to my studies, and that's why I didn't do so well. And I'm like, I don't care. Personal statement. Who wants to read that? Okay. Also, to keep in mind here is that in the financials, you can see that in the financials, income statement is being calculated, a balance sheet is being calculated, and a statement of cash flow is being calculated for what you're working on. And in the financials, this isn't filled in, but in the financials, a pro forma financial statement is created, which is one of the subjects from the next chapter. But I just want to show you that financial statements and financial ratios are pretty close to the heart of the simulation as far as how are you going to be assessed in your performance? And this is the same way companies are assessed. When an analyst is analyzing a company to put a recommendation on it, they're analyzing the financial ratios, and they're looking for improvement. And if you look at any of the news today, if a company comes out and they didn't improve their sales or their profits, the stock tanks. And there's a couple companies that came out, LinkedIn came out, and they said, yeah, our revenues aren't improving. Sorry, not sorry. And the stock market said, no, you're sorry, because we're just going to cut half your total company worth out from under you in one day and just rip your stock down from 200 to 100 or whatever the numbers are. Because they disappointed. Their year-over-year expectations were not met, and the financial ratios weren't as good as the analysts thought, and the company got creamed. And that's why, as financial managers of your company, you have to increase your profit margins. Every round, I want to see these profit margins going up. You increase your profit margins, it's going to increase a lot of your ratios, because a lot of your ratios are based on your profit margin. Total asset turnover, equity multiplier, return on equity, earnings per share, return on assets, are going to be based on how well you increase your profit margins. So that's why it's critical to understand what these financial ratios are and how they're interpreted. And you need to apply that knowledge back to when you do the simulations. The whole reason we have the simulation is I could go blah, 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 financial ratios, you're just like in one ear out the other, who gives a crap. But then when you're actually being graded on it and you actually have to perform and compete on it, you need to understand what those financial ratios are to understand how to improve them. So if you understand what the financial ratio is, then you have the keys to know how to improve it. It's very simple. How do you improve gross profit margin? Well, what's the financial ratio? It's, gross profit divided by sales. Okay. I have to increase my gross profit to get that to be higher. It's pretty simple. So now you have the clue. I just have to increase my gross profit number. How do you increase gross profit? What is gross profit? Well, it's sales minus cost of goods sold. Well, what's in cost of goods sold? Well, let's look. Direct labor and materials. So if I'm building a product here, actually, let me take the first example. I'm building a product, so the first thing you say is, let me exceed all my customers' expectation and make the most awesome car possible, because that's what companies do. I know that's a fact, because that's what the advertising tells me. And I said, I'm gonna sell this at the lowest price possible. Yeah, oh, negative gross profit? What the hell? I made the best car possible. How am I losing this game, Professor Nugent? I made the best car possible at the lowest price. I don't understand why I'm not beating everybody. Well, I'm sorry, student, but you obviously know nothing about business. And you might want to rethink. I know they're looking for people in art history majors, maybe, because you I think that's where you would fit in best. So what really happens in the auto world is they see what your expectations are, but a lot of times they might just be able to meet the bottom line of your expectation, or they might actually go below your expectations, because So these are the expectations, how important they are. So I should probably, this is really important, I should increase this. But if horsepower isn't so important, what do they care? I'll decrease that. It's called a Prius. All right. So now I got my profit margin up to 43%, but that's not beating my profit margin was 50% last round. So if I come in with a 43% profit margin to my investors, they're going to be like, what the hell did you do? You wrecked the company. Oh, I just wasn't looking at that. I didn't think that was important. Well, you're damn right it's important. If you don't increase your profit margins, you're not going to make any points in the simulation. Your stock price isn't going to go up. Okay. Don't have to be a total tyrant over it. I'll just increase my price of the car. There we go. And look at that. I back up to my profit margin to where at least, hopefully better than last round, maybe a little bit better. So that's how this all kind of plays together. So what you're learning in this class can directly be applied to this simulation. And this is your one chance to run a company. Because a lot of times I'll teach executives at the MBA level, and they work in businesses and they run companies. So when I'm talking about this stuff, they're like, yeah, I know. This is great. Yeah, I do this at work. I totally understand. It's the easiest class to teach. When I teach you guys, you're like, I just watch commercials and believe whatever companies tell me. I don't care about profit margins. So you have no reference, no idea what it takes to run a business, unless maybe your parents own their own business and you have somewhat of an idea, But this is what this is supposed to get you closer to the point where you care about and you know how to run a business to the point where you're making money. Because that's basically what you're going to be doing when you graduate to a certain extent. So that's why it's important that you take the simulation seriously and apply what we're learning in this class to managing your company better and improving. And one of the reasons I'm having you do the practice rounds is to see that, okay, this is my base level of how I perform when I really don't know too much about what I'm doing. And then as the class goes on, hopefully you learn more and you understand what you're doing and you can improve your performance in the actual team competition. But you can't improve your performance unless you understand the basics of financial statements and you understand how financial ratios are calculated and how they're analyzed. And that's going to be what the rest of this chapter is about. Now, who's interested? Who else is interested in these financial ratios? Well, you have your potential shareholders. If you want people to buy your stock, okay, let's picture this. You come up with a great idea for an invention, right? You found a way to make a great website or a great product or a great new soda or a new solar panel or a car that runs on water, whatever. You have a great product, right? And you're going on Shark Tank and you're talking to Mark Cuban and they want to invest in your company and you're feeling really great about yourself and your company gets started. Then the next thing you have to do once your company started and it's going great and you're public and you're making money, now you have to convince people to buy your stock. So that's why shareholders, prospective shareholders and current shareholders are very curious about your financial ratios. You know, they want to see that your company knows what they're doing. So they're not going to buy your stock unless you have good financial ratios. Just like you're not going to get into graduate school unless you have good undergraduate grades. Because they're going to look at your grades. A grade is basically like a ratio of how well you did in class. Okay? Think of it that way. Say I had to evaluate your performance in a business class, marketing. I could take all your work that you produced for marketing, all your tests and your papers, and I could review all of them and get an idea how well you did in marketing. Or I could just look at your grade. Isn't it a lot easier just to look at your grade than me to review all the work you did? That's what financial ratios do. Rather than having financial people review all the work of the accountants, we could just go to this grade, which is a financial ratio, to get a short-cut, clean-cut idea of how you did. Creditors are also very much interested in your financial ratios because they're not going to lend you money if your company is a loser. Just like banks won't lend you money if you're a loser, financial loser. You could be a winner in other areas, but if you're a financial loser, have a low credit score, or have a judgment on your credit score, or have unpaid credit card balances, no one's going to want to lend you money or give you credit cards. That's why you have. How do they know what's a credit score? It's your financial ratio for yourself. So if you look up your credit score and you see that your credit score is 400, that's bad. Basically, these companies are creating financial ratios about you and putting it together in one score. So someone who's a loan officer says, should I lend you money for a house or a car? Let me look. I don't want to review your whole financial history. I don't have 5 days to do this. Just look at your credit score. I know right away what to do. That's a financial ratio. Management is also going to be concerned and want to look at the financial situation of the company. So management can use financial ratios to figure out what went wrong. And that's sort of the DuPont model that we're going to go over at a certain point to figure out what went wrong in the company. Okay, so we have cross-sectional and benchmarking, and 2 ways to do it. So cross-sectional would be a comparison of financial ratio at some point in time. But we're going to do it within an industry. So it sort of be like a cross-sectional analysis would be me looking at your results in the Zoom simulation against all the other companies in the Zoom simulation, all the other teams. So a cross-sectional, I'm going to compare all the financial ratios across all the different firms. I'll probably make an industry average and say that, the current ratio is an industry average of 3. So if your company's below that, I know you're doing worse or subpar compared to everybody else. All right. There's also benchmarking, where you can do a cross-sectional analysis, and then you're going to compare the key competitors in the group to your financial ratios. This is something that you can do in the simulation. This is how you would do that in the simulation. You look at industry tab, and in here you can benchmark how you did against your competitors. So you can see how they built their vehicles, what their profit margin was, their sales, their cost of goods sold, their advertising costs, and their financial ratios. That would be an example of benchmarking. So you could benchmark yourself. So if we do the team competition round 1, which is due February 17th at 11 p.m. or 11:30 at night, and we calculate that, and you have the lowest points of every team, shame. It's going to be like Game of Thrones, going to make you walk naked down the town, and when there's this guy behind you with the bell, shame, shame. You don't want that. That was a little extreme of an example, but if you are in that last place position, you need to go to the industry tab and say, what do the other teams do? At least get me somewhere in the middle of the pack, and you need to say, where did I deviate that made me have such a low score? That's benchmarking. All right. Okay. Let's talk about inventory turnovers. Okay. So we have this Cadwell Manufacturing has inventory turnover of 14.8, and the industry average is 9.7. So are they doing better or worse than the industry? It's better, but do you know why it's better or how it's calculated? Well, let me tell you what inventory turns are. Think of a toy store, okay? So you have a toy store, and on January 1st, you're going to buy every toy that you're going to sell for the whole year. So January 1st, you buy every toy, and December 31st, you've sold everything that you purchased on January. Never bought anything else the whole year. That would be inventory turn of 1. Let's do an inventory in your house. On January 1st, you buy 52 boxes of cereal to last you the whole year. And then by December 31st, you're on your last box of cereal, and you're done. See how inefficient it is? Can you imagine storing 52 boxes of cereal in your kitchen? Some might spoil, some could be stolen, some could go to waste. You see what risk you're putting yourself under? How much money would it cost to buy 52 boxes of cereal? What's the average cost of a box of cereal is, say, $4. So it's about $200 of cereal. It's a lot of money to spend in 1 week. But what if, now this is crazy, what if you just bought 1 box for a week? So you buy that 1 box, you eat it, and then the next week you buy another box. How many turns would you have in your inventory then? 52. So you're going from full inventory to 0 52 times a year. So you're turning your inventory. So the more you turn your inventory, the more efficient the company is because they're spending less money on inventory at any one point. They only get 1 box of cereal. They need less storage. There's less theft, less breakage, less spoilage. So it's more efficient. So as long as now each industry is different. The amount of inventory some industries hold is much more than other industries. So if you were going to make a liquor store, you know how much inventory you need for a liquor store? Hundreds of thousands of bottles of booze. Nope, dollars. Maybe not hundreds of thousands. I don't know how much it is. Say $100,000 to buy all that liquor, because it's not just cheap liquor. You're buying the top shelf stuff too, and the expensive bottles of wine, and it's a pretty big store. Maybe it's Stu Leonard. That's it. Or maybe you're opening up a laundromat. What's your inventory in the laundromat? Maybe some soap, some rags, a couple, the washing machine's dryer's not inventory. Those are fixed assets. So you can see there's not a lot of inventory in running a laundromat compared to running a liquor store. So you can't compare those two industries together, inventory turns. So that's why you usually have an industry average to look at. Whoa. Okay, this is table 3.1 from your book, and it's giving you an industry. It's giving you different companies within industries and then a set of ratios. Don't worry if you can't see this from where you're sitting. It's just an example of how you can lay this out. But it's financial ratios for select companies in their industry. So you always want to compare your company to your industry, not your company to other industries, because different companies have different requirements and ways of the business operating. Okay, time series analysis. This is when we're evaluating financial ratios over a period of time. This is sort of like someone evaluating your transcripts. How is your transcript? Have you looked at it? You're happy with it? Could be better? Is anybody here a 4.0 student? No. So you want to see that you're improving over time, and you should be improving because you sort of a freshman, you don't know what you're doing exactly, you don't know how much to study or what classes to take. Then somewhere as a freshman, you learn to look at rateyourprofessor.com to figure out who has the easy classes. Then you make some friends, and your friend says, "Oh, I gotta join this class. This class is like down to anything. Just watch movies, and do some discussion boards." Like there's a class. There used to be a class on campus like that where you just watched movies and did some discussion board work, and that was it. And everybody got an A. You know what happened? So on the student evaluations, kids were like, too easy, there's no work, class is a joke, teacher's a joke, this class is a waste of time. So you know what happened? Now there's a term paper, a test, a quizzes, books to read. So because the next evaluation, this class is too hard, there's too much work. I don't know why I took this class, I'm failing it. So then, what do you think the dean of that program is going to say? Like, wow, you really stepped up. You made a great class now. All the students are complaining about how much work there is. So, this is a true story. And I'm sure you've done that on your evaluations. You love it while you're in class and it's easy, but at the end of the class, you put that evaluation, you're a little too honest, and the next people taking that class can thank you for a much harder class. This class was a breeze, too. This class, there was no tests, no textbook. I just talked and gave everybody an A. But then people wrote, this class is too easy, so I made it a lot harder. So if you write that again this year, I'll make it even harder. I'm just kidding. None of that's true for me. It was always hard. But people look at, why I bring this up is people need to evaluate the past. So your faculty do look at these evaluations to improve the class. You should look at your, when we look at your transcripts, you want to see that you're improving semester after semester as you're becoming more efficient as a student, a better college student. Where now, students, I know students only do what they need to do to get the points they need to get the grade they want. So if it's, things that aren't going to directly translate to a grade, they're not going to do. I had one girl telling me today, like, oh, I didn't know there's any points associated with completing the practice rounds because I was just not going to do them. I'm like, oh, you better read that assignment again because there are points associated with completing that. If you don't complete it, you're not going to get those points. Oh, for some reason I thought it wasn't graded. I don't care what you thought. It's not going to change the fact that it's graded. These are the conversations I have with students. No one from this class, though. This class is actually pretty good. All right, so let's look at an average collection period in days from 2012 to 2015. So we have the industry and Bartlett Company, and we'll see that first you have to understand is what's the average collection period mean? So average collection period, is that good, bad? What does this mean? You don't know because you don't work in a business. You're a student. What do you know about average collection periods? What do you care? But what they are is it measures how many days it takes you to collect your money. Right? So if you've ever been in the business where you need to collect money from people, you know it's important to get that money sooner than later. Right? Maybe you're a loan shark and you want to collect that money. Is there such thing as loan sharks anymore? I think they're called banks now. Credit card companies, that's what they're called. Because they lend you money at 22% interest rates. I make it my life's mission to get as much money from the credit card company without paying them a dime. So I'm always paying my balance off in full, so they never get any interest on me. And I'm always trying to take advantage of whatever services they can offer me, whether it's like 2% back or calling them and bugging them about, concierge services or whatever. Yes?
I do that when, they have like the 1 year 0% interest thing.
You take it.
Spend all the money and then pay it off.
Yeah, you should do that. But be careful, though. Don't cancel the credit cards. It negatively affects your FICO scores. Okay. So here we have the industry started out about 48 days and still around kind of 48 days, kind of dipped here a little bit. So the industry didn't make too much changes in the average collection period. However, this company increased from about 42 to say about 55 days. So that's a problem. It's taking them longer to collect their money. Why would it take a company longer to collect their money? Well, it could be incompetence. It might be the fact that they hired somebody that doesn't know how to do accounts receivable correctly. It could be the fact that their credit terms are too generous, that there's no penalties. You know, that's why they came up with this 210 net 30, meaning that if you pay in 10 days, you get a 2% discount. And pay in 30 days, you pay the full amount. So they do incentives, or they could do what I used to do, just call. I used to call other companies and be like, are you going to pay us or what? That's exactly what they'd say, or you got the wrong department. I had this little trick that really helped me to collect money at companies. So whenever I called the accounts payable department, because accounts receivable calls accounts payable, to collect money, they would never want to talk to me, or they put me right to voicemail. They don't want to hear from me. So what I would do is I'd call their accounts receivable department, and they always pick up those calls because that means they're going to get paid, right? So I'd call them and be like, oh, I'm trying to reach this person. Can you connect me? So internally, they're transferring me from accounts receivable to someone in accounts payable, and they're probably friends, so they're totally going to pick up the phone because Susie's calling. Maybe she wants to go to lunch. But no, it's me, Mike, and I want my money. So that was my secret weapon. Now you have to talk to me. So this company is not doing good compared to the industry in a time analysis. So time analysis can be very important and very useful for calculating. Okay. Using financial ratio. Cautions about using financial ratios. Okay. Number one. If the financial ratios are suddenly drastically different, that needs to be looked into. So the deviations from the norm, there's usually a problem there. So generally financial ratios, we want them to improve, we want them to do very well, but if they suddenly jump up for no reason or jump down for no reason, you need to investigate what happens. You know, so say you're looking at a company, suddenly their profits jump tremendously. You need to look into that, because you know what, it could be a one-time tax credit or a lawsuit, winning a lawsuit. There could be a couple of reasons for that. So you really need to look into that. A single ratio does not tell you the whole story. It's not sufficient information to judge the overall performance of a firm. So you can't look at one ratio. Like, again, going back to your transcripts, if I see that you failed marketing, but you have A's in every other course, I can't judge you as a student based on that one class. I got to look at all your classes. Why did you fail marketing? Because you didn't take Professor Edel. That's why you failed marketing. Professor Edel is the best marketing professor, right? Well, that's what he tells me. So I just tend to believe him. Right? Did you never have Professor Edel? Oh, you're missing out. Oh, well. The ratios are being compared, should be calculated using financial statements that are dated at the same point in time. So they have to line up. So if you're gonna count, and I see students in my investment class making this mistake. I asked them to generate analysis of a stock industry, and they're taking financial statements that from one company from two different periods and creating financial ratios from information from two different financial statements. That makes no sense. They have to be the same financial statements for the same period of time, the end of the year, whatever, 2014. You can't use 2013, some items from 2013 and some items from 2015. It's not a Chinese menu where you have one thing from column A, one thing from column B. Ever see those type of menus? Yeah, it's not like that. I want Chinese food right now. For some reason, suddenly, that's why I brought that up. Okay, it's preferable to use, of course, audited financial statements that someone's validated and said, if you ever worked for a company and the auditors come in to audit your company, you have to prove to them that your books are correct. So you have to provide them data and information, and they have to go through and basically reconstruct your financial statements and test them to make sure that your financial statements are accurate. And then that's how and then also audit and create your financial ratios. So it means that somebody outside of the company double checked to make sure that your accounting was all correct. So of course audited statements are better. 5, financial data being compared should have been developed in the same way. Okay. And results can be distorted by inflation. Oh, that's an important one. Inflation, you can't compare the results, the direct dollar results in 2015 to the year 2000, because there's an inflationary difference. Just like you can't compare, if I was to ask you to compare the box office from Star Wars, the original, from 1977, to Star Wars The Force Awakens from 2015-16, basically the same movie, but which has a higher box office total? New at $2 billion, right? It's like at $2 billion? It's a lot of money. However, if you take the 1977 film and you adjust it for inflation and bring it forward, that's a bigger box office total. Because I remember the year 1977. A movie ticket was $2.50. That was great. Today, it's what, $12, $13? So if you count the tickets actually sold, multiply that by $13 a ticket, or whatever the average ticket cost is, that's how you can see what the inflationary value of that film is. So that's why you have to look at year to year. It's not a big deal, but over a series of years, you have to account for the inflation of money. Okay. So we're gonna analyze financial statements of this Bartlett company using the income statement and balance sheet that we provided earlier. So the first financial ratio we're going to talk about is the current ratio. And the current ratio, we're looking at current assets divided by current liabilities. Easy enough. But the critical thing here is, what does this mean? Well, you do agree it's better to have assets than liabilities. So, since assets are being divided by liabilities, the higher this number, the better. The more current assets they have compared to the liabilities, which means that they have a better ability to pay their liabilities. So if I have $1 million in current assets in cash, and I have $100,000 in credit card debt, that's not a problem. You know, so if I go up to you, right? Say we're on that date again, and I go up to you and say, "Hey, I got $200,000 in credit card debt." You'd be like, "That's a problem." And then I'd be like, "But I have $2 million cash in the bank." And then you'd be like, "Problem solved." So that's why you have to compare these two together. That joke's based on the episode of The Simpsons where Marge develops a gambling habit, and she's at the casino gambling a lot, and then Homer confronts Marge about this, and she says, "Oh, I just won $1,000," and he's like, "Woohoo! Problem solved." So that's what that joke's based on. Watch more of The Simpsons. As a matter of fact, what's the title of this slide? I don't know why. Determination of liquidity needs. So we have to figure out how liquid you need to be. So all businesses have relationships with banks, and banks will provide businesses with lines of credit. And these lines of credits are sort of like short-term loans. And in the event the firm needs some quick liquidity, they can go to the bank and take lines of credit. So line of credit is like a pre-negotiated amount of money that you can borrow, sort of like a home equity loan. So you pre-negotiate and you're approved by the bank to borrow up to $10 million. So you may have a short-term credit crunch, meaning that you need to buy a lot of inventory to get ready for Christmas. So you go and you take money out on your line of credit to build this inventory. You sell everything at Christmas, you pay the bank back. So smaller firms don't have the same amount of access that the larger firms do. So they tend to need a higher amount of liquidity in their current ratio than the bigger company. So a bigger company has better access to money and can borrow money quickly, and they don't have to worry about their liquidity position as much as a smaller business. The smaller business won't be able to borrow money as fast. Okay, I have to go off the record. Personal financial example. So a personal liquidity ratio, you can calculate this on yourself by dividing your liquid assets by your current debt, which basically would mean current debt would be anything that you have to pay within a month or two. So you could take your cash that you have and divide it by maybe your credit card payments and your car loan payments. Would be like a quick current ratio on yourself. So for Jan and John Smith, liquidity ratio of they have 2,000 in current assets and 21,000 in liabilities. So their liquidity ratio is pretty small. So indicates that Smiths can cover only about 10% of their existing one-year debts obligations. So that is actually a bad thing. Okay. So before we go to this next slide, I'm not going to cover this slide. We're going to cover this next